If you can't sit tight, you can't win. The market punishes movement and rewards patience. But most men would rather move fast toward ruin than wait slowly for truth. What you'll learn today isn't theory, it's survival. I'm going to show you the 3 rules that turned me from a gambler into a trader, rules written in loss, not ink. If you've ever felt the rush of being right and the sting of losing it all the next day, this is for you. Because luck will feed you once. Discipline feeds you for life. By the end of this lesson, you'll know how to stop gambling with your time, your money, and your mind. I used to believe trading was about speed, getting in first, getting out faster. Then the market taught me patience with a whip. You've probably felt it too. The excitement when a trade starts working, the panic when it turns. That swing of hope and fear is the gambler's heartbeat. Every beginner feels it. Most never outgrow it. But I learned that markets don't reward emotion. They reward observation. When you stop needing to win every minute, you start learning how to win for good. That's when you begin to trade like a professional. In this session, I'm going to walk you through the 3 laws I lived by in every market I ever traded. They're simple, brutal, and they never fail. First, I'll show you how I learned to wait while the crowd rushed. Then, how I risked small when the fools risked everything. And finally, how I sat tight when the whole street was shaking apart. Each rule comes from a real fight I had with myself and with the market. If you understand them, you'll never need luck again. Because this isn't a game of chances. It's a game of character. Stay with me, because once you hear the 3rd rule, you'll understand why most traders lose before they even begin. Most traders never realize this until it's too late, until the market takes everything they thought they knew and folds it into silence. Here's something most people completely miss. The market doesn't punish you for being wrong. It punishes you for being early. When I first began trading, I believed that being early meant being smart. If I could predict where the price was heading before everyone else saw it, I'd be rich before they even caught on. That's what I told myself. And that lie cost me a fortune. I remember it clearly. Union Pacific. Back in the days when a rumor could shake the street like thunder, I felt a move coming. The tape looked heavy to me. The air felt different. And I told myself, this is it. This is the top. So I sold short, feeling clever. For a few hours, it even looked like I was right. But then, the market turned, not because I was wrong about the direction, but because I was wrong about the timing. The move I'd waited for did come, but not before it took me out of the game. I watched price rise against me, margin calls piling up like waves, and I realized something that took me years to say out loud. The market doesn't care about my anticipation. It only respects confirmation. I learned that day that the difference between a gambler and a trader isn't luck or knowledge, it's patience. The gambler guesses. The trader waits. A gambler looks for movement. A trader looks for behavior. A gambler bets on what should happen. A trader waits to see what is happening. You see, markets don't move because we think they should. They move when pressure breaks, when every buyer has bought, or every seller has sold, and the weight of that imbalance tips the scale. Until that moment, the market is just storing energy, and the impatient pay the price for trying to make it move before it's ready. I've seen men lose fortunes not because they were wrong about the direction, but because they couldn't wait for the market to confirm what they already believed. They guessed, they jumped, they fought for a head start, and they ended up running into a wall. That wasn't there yesterday. If you're trading because you feel something coming, you're already in danger. Feeling is for gamblers. Observation is for traders. Look at the tape. It tells you what the market is doing, not what you want it to do. Patterns repeat. Prices fluctuate. But human nature, that never changes. Impatience has ruined more traders than ignorance ever could. Most people think anticipation and impatience are the same thing, but they're not. Anticipation waits for the market to agree. Impatience acts before it listens. That's why I say, don't forecast, price observe behavior. Don't predict the future, wait for proof that it's arrived. Because when you start trading to be right, you stop trading to make money. That loss in Union Pacific taught me something I never forgot. It's better to miss the first act of a move than to get buried in the rehearsal. When the market confirms, you'll know. You'll feel it in the rhythm, see it in the tape, and the move will carry itself without your push. That's when trading stops feeling like gambling. That's when patience starts paying. That loss taught me the difference between wanting to be right and waiting to be certain. Here's something counterintuitive. Most people think the key to trading is boldness, courage, conviction. They believe you win by stepping in before everyone else, by having the guts to act when others hesitate. But the truth is, I made my biggest fortunes by doing the opposite. I waited. I waited for the market itself to tell me I was right before I ever moved a dollar. That's not hesitation, that's confirmation. A stock is never too high to buy if it's going higher, and it's never too low to sell if it's going lower. That rule has saved me more money than any prediction I ever made. Because when a stock proves it's strong by breaking into new ground, that's not a warning, that's your invitation. The amateurs panic at new highs, the professionals prepare for new profits. When I say confirmation, I don't mean hope. I don't mean a feeling. I mean evidence. The market leaves a trail, and that trail is price action. If your opinion and the tape disagree, the tape is always right. I learned that from experience and from pain. The market will prove your view correct by its behavior, not by your belief. Watch the way it reacts after a move, how it digests news, how it handles pressure, how it trades when no one's watching. Those small tells mean everything. You see, when a stock breaks through a level, it couldn't pass for weeks. That's confirmation. When volume increases while price rises, that's confirmation. When the market shrugs off bad news and still climbs, that's confirmation. And once I see those signals, I don't argue. I don't hesitate. I don't guess. I act. That's my entire formula. Wait until the market agrees with me, and only then move. It's not glamorous, but it's deadly effective. I remember a young trader once asked me, "How do you know when to buy?" I told him, "When it's obvious." He laughed, thinking I was joking, but I meant it. Obvious doesn't mean easy. It means the market itself has spoken so loudly that even the crowd can hear it. And by that point, the move is already underway. That's when the trader moves in, not at the rumor, not at the noise, but at the proof. It's like a boxer. You don't swing because you think there might be an opening. You wait until you see the opponent drop his guard, and then you hit with everything you've got. A fighter who swings too early gets countered. A trader who trades too soon gets broken. Waiting for confirmation is your guard, your defense, and your offense all in one. I often say, the market is like a wild animal. You don't chase it. You track it. You watch its habits, its pauses, its movements. The hunter who charges too early gets trampled. The one who waits for the right moment doesn't need to run. He just fires once and walks away with the prize. That's trading. You're not forcing anything. You're letting the setup come to you. And yet, waiting is the hardest thing in the world for most traders. They feel like they're missing out, like the market will leave them behind. But the truth is, the market isn't going anywhere. It will always be there tomorrow, next week, next year. Your capital might not be. That's why I wait. Because proof is safer than prediction. Proof keeps you alive. When the market confirms your judgment, it doesn't need your help to move. You can feel it in the tape. The flow gets clean. The rhythm steadies. The noise fades. It's almost quiet. That's how you know the move is real. And when it's real, you don't have to fight it. You just ride it. Every trade that made me rich began the same way. I watched a stock act right. That's all. Not because I dreamed it would, but because it showed me it would. The market told me, I'm ready. And I believed it, because it had proved it. So when you're sitting there, staring at your screen, feeling that itch to act, don't. Wait until the market gives you something solid. Wait until it confirms your view. Because when you act on proof, you move with the market. When you act on hope, you move against it. Once you learn to wait, the second challenge appears. Knowing what to risk when your moment finally comes. Patience, to most men, sounds like inaction. They think it means doing nothing while the world moves without them. But that's not patience, that's paralysis. True patience is preparation. It's quiet readiness. It's sharpening your blade while the rest of the crowd charges into battle with dull knives. I've seen more men ruin themselves because they couldn't stand still than because they acted foolishly. They always need to do something, buy, sell, chase, tinker, anything but wait. And that's what destroys them. Because in speculation, the waiting period is not wasted time. It's the most valuable time of all. It's when you gather strength, refine judgment, and build conviction. When the real move comes, you're not guessing, you're prepared. I learned this the hard way, like every trader does. Early in my career, I used to think money came from trading. Now I know it comes from waiting while trading. There's a world of difference between the two. When I was young and full of energy, I couldn't sit still. I wanted to trade every day, sometimes every hour. I'd take small profits, cut good trades short, and jump to the next one, always afraid that if I didn't act, I'd miss something big. I thought movement was progress, but it wasn't. It was noise. Every tick of the tape pulled at my nerves. Every swing of price made me think I was losing control. The truth was, the market wasn't moving me, I was moving myself. Then came a lesson that broke that habit. I remember a time I held a position in wheat and another in cotton. Both had looked promising. Then the reaction came, a normal, healthy correction, but I didn't see it that way. I panicked. I closed out too soon, convincing myself I was being cautious. Days later, the real move began, and both commodities went exactly where I'd expected them to go. Only difference was, I wasn't there anymore. That loss wasn't financial, it was psychological. It proved I didn't yet understand the hardest part of this business, doing nothing when everything in you screams to act. Sitting tight is the only real work in speculation. People think the hard part is finding the right trade. It's not. The hard part is having the discipline to stay in it once you're right. It takes courage to open a position, but it takes character to hold it. When I say sit tight, I don't mean sit idle. I mean sit focused. You keep watching, but you don't interfere. You protect your position, but you don't smother it. You don't dig up the seed to see if it's growing. You water it and wait. The amateurs think they can outsmart the market by being faster, but speed is the weapon of gamblers. Stillness is the weapon of professionals. Patience filters noise from truth. Every tick, every rumor, every headline, most of it is distraction. The longer you can stand still, the clearer the truth becomes. That's why patience is not weakness, it's strength under control. It's not about waiting for the perfect moment. It's about not wasting your ammunition on imperfect ones. When I waited for my trades to mature, when I gave the market time to prove me right, I discovered something miraculous. My results became predictable. My wins were no longer accidents of timing, they were outcomes of rhythm, of understanding, of alignment between my conviction and the market's movement. I realized patience isn't passive, it's participation at a higher level. It's saying, I know where I stand, and I'll let the market come to me. 2. Most traders lose money not because they misread the market, but because they rush the truth. They can't stand silence. They need the excitement of action. They call it opportunity. I call it desperation. If you can master the art of waiting, really waiting, you'll separate yourself from 90% of the crowd. That's where the profit is hiding, in the quiet space between noise and certainty. I often compare trading to chess. In chess, a master doesn't move every piece just to stay busy. He moves when the position demands it. Sometimes he'll sacrifice a pawn, take a small controlled loss to gain better ground later. That's what patience looks like in the market. You may take a small hit today to secure a stronger setup tomorrow, and when the board opens up, when everything aligns, that's when you strike. But if you move just to move, you'll lose every piece before the real game even begins. Patience has a strange effect on your beacons of very thinking. It slows you down in a world that punishes hesitation, yet it makes you sharper than everyone running at full speed. It teaches you to separate motion from meaning, to see what others are blind to. The impatient man sees price, the patient man sees structure, the gambler sees movement, the trader sees cause and effect. So if there's one habit I'd drill into anyone who wants to stop gambling and start trading, it's this. Learn to wait until your moment is undeniable. When your analysis, your observation, and the market's action all align, that's your strike. Until then, wait. Don't fill the silence with noise. Don't turn discipline into distraction. Wait like a lion in the tall grass, silent, still, watching the herd move closer because one well-timed leap is worth 100 blind chases. And when the move finally comes, when price confirms what you've been waiting for, you'll act with a confidence the gamblers will never know. Because you didn't chase the market, you let it reveal itself. That's how patience turns into power. Once you master patience, the next rule becomes your shield, because even the right timing means nothing if your capital dies too soon. Here's a truth that took me longer to accept than it should have. Losses are part of the game. I used to hate them. I thought every losing trade was proof that I'd failed, that I'd misread the market or made some amateur mistake. But that's not true. A loss, when taken right, is the cheapest form of insurance you'll ever buy. It's the price of staying alive long enough to catch the next real opportunity. I've said it before and I'll say it again. Taking small losses is cheaper than taking one catastrophe. And most men don't understand that until the catastrophe comes for them. There was a time I thought I could outthink the market, that if I just waited long enough, the price would come back my way. I'd tell myself, it's only a paper loss. But those paper losses turned into real ones, big ones. I remember my cotton trade vividly. It was one of those situations where every instinct in me screamed to hold on, to be patient, to give it room to breathe. But that wasn't patience, it was pride wearing a mask. I was wrong, and I refused to admit it. The market kept moving against me, slow at first, then faster, until I couldn't breathe under the weight of it. That one trade, that one refusal to take a small loss, cost me months of gains and nearly broke my spirit. I learned from that mistake that the first loss is the best loss. It's the cleanest, the smallest, the easiest to recover from. It's the wound you can bandage before it becomes fatal. When you're wrong, the only thing you can control is how much it costs you to learn the lesson. That's why I take losses fast, without emotion, without argument. The longer you wait, the more you'll pay for the same truth. I tell traders all the time, never average down. Never throw good money after bad just to protect your pride. That's how gamblers think. They say, I'll double down and make it back. But that's not strategy. That's desperation dressed up as confidence. Every time you average down, you're not investing, you're voting against yourself. You're saying, I was wrong, but I refuse to accept it. And the market punishes that kind of arrogance without mercy. When I look back at my career, I realize my greatest victories were built on top of quick, clean losses. Small ones that cleared the field so I could fight another day. That's how I survived every panic, every crash, every manipulation that broke others. I didn't have more courage than they did. I had more respect for risk. I treated my capital like a soldier treats ammunition. You don't waste bullets trying to prove a point. You fire when it counts, and you save enough to fight the next battle. You see, your capital isn't just money, it's opportunity. Every dollar you lose recklessly isn't just gone from your account, it's gone from your future. It's one less chance to strike when the real move comes. And that's what separates the gambler from the professional. The gambler wants to win now. The professional wants to stay alive long enough to win later. Protecting capital is about humility. It's the act of saying, I don't know everything, and I don't have to. Every trade is a hypothesis. The market is the experiment. If it proves you wrong, don't argue with the results. Close the trade and move on. There's no shame in a controlled loss. The only shame is in pretending you can't be wrong. I remember sitting alone one night after a losing day, looking over my notes, and realizing something that changed how I viewed this business. I wasn't losing because I didn't understand the market. I was losing because I refused to understand myself. I thought I was protecting my pride when I was really destroying my capital. And once the capital's gone, pride doesn't buy it back. Losses are not enemies, they're information. They're your tuition. You pay them to the market so you can keep learning. The trick is not to pay the same lesson twice. A small loss teaches. A large one punishes. I take the lesson, record it, and move on. Because every loss taken early saves me from the disaster I can't afford later. Think of it like this. You're a captain on a ship. There's a small leak in the hull. You can patch it right now and keep sailing, or you can wait and hope it seals itself. But the sea doesn't care about hope. Sooner or later, the water gets in, and it's not the ocean that sinks the ship, it's your refusal to act when the first drop appeared. That's what a small loss is. A patch, not a hole. I've watched traders blow up accounts that could have lasted decades because they refused to accept a simple truth: the market doesn't care about fairness or how hard you worked for your money or how much you believed in your trade. It only cares about price, and price is the final judge, jury, and executioner of every opinion. When it moves against you, that's not personal. That's the market telling you to step aside. If you don't listen, it'll take your capital, and it'll take your nerve right along with it. That's why I say protecting capital isn't about fear. It's about respect. Respect for the law that governs this business, the law of uncertainty. No man alive can control what happens next. All he can control is how much it costs him to be wrong. So when I lose, I don't complain. I don't curse the market. I just pay the tuition and get back to class. Because as long as I've got capital, I've got another chance. And as long as I've got another chance, I've got a future. You can't survive without protection, but you also can't grow without position. If there's one lesson I wish I could tattoo on every trader's hand, it's this. The size of your trade will decide your fate more than your timing ever will. Most people don't believe that. They think the big wins come from bold bets, from loading up when they feel certain. But certainty is the most dangerous illusion in this business. The market doesn't reward confidence, it rewards control. I learned that every great fortune I made came from a position that grew after I was already right, not before. That's the quiet secret, the thing no one wants to hear because it's not exciting. You build size through proof, not through prediction. Early on, I used to think I could force results by trading larger. The logic seemed sound at the time. If 1,000 shares make me $1,000, then 10,000 should make me 10,000. But markets don't move in straight lines. And the moment I increased my exposure before the move was confirmed, the market showed me just how wrong that thinking was. There's no faster way to go broke than to trade too large in an uncertain situation. The irony is, when you're right, the market pays you to get bigger. When you're wrong, it punishes you for being greedy. The difference is subtle but deadly. When I pyramid a position, I do it like an engineer testing a bridge. I build one pillar at a time. I don't trust the structure until it's carried real weight. I'll start with a small commitment, just enough to get a read on the market's behavior. If it acts right, if the price moves in my favor and the reaction is normal, that's proof. That's my signal to add another pillar, to reinforce the position with profits, not with hope. Each new addition must stand on the shoulders of a winning trade. That's how you scale safely. It's slow, it's methodical, it's dull, and it's the only way you survive long enough to get rich. Every trader dreams of swinging big. They want the thrill of going all in, the adrenaline of risking it all for one glorious victory. But I've seen how that story ends. I've seen it 100 times. It ends with empty accounts and broken spirits. You don't need to risk your life savings to prove you understand the market. You prove it by staying in the game while others are getting carried out. The trader who trades small enough to make mistakes and still live, he's the one who wins in the end. You see, trading is not about maximizing returns, it's about minimizing regret. The gambler risks everything to get rich once. The trader risks little to get rich steadily. You must protect your ability to act again tomorrow. That's what position sizing does. It preserves your future. I'd rather miss 100 opportunities than take one position that's too large for my account to bear. Because when the storm comes, and it always comes, it's not your strategy that saves you, it's your exposure. I remember the day I learned this truth with painful clarity. I had a string of good trades, everything I touched turned to profit. The kind of run that makes you feel untouchable. I started increasing my size on each trade, telling myself I was compounding success. But what I was really doing was compounding risk. One bad break, one sharp reaction, and in a single afternoon I lost more than I'd made in a month. The profits vanished not because my idea was wrong, but because my size was too big for the inevitable pullback. It took that shock to teach me that the goal is not to win the most, it's to lose the least when you're wrong. I trade like a general moves his army. I send in a small force first, just to test the terrain. If they find ground that holds, then I send more. If the market repels me, I retreat with minimal damage. That's strategy. That's patience turned into precision. You let the market prove itself before you commit your full strength. Most people blow up because they confuse conviction with overconfidence. Conviction is earned through observation. Overconfidence is born from emotion. The moment you let excitement decide your size, you're not trading, you're gambling. The best traders are conservative when entering and aggressive when proven right. They risk small when uncertain and press big only when the market confirms they're on the right side. That's not cowardice, that's wisdom. When you learn to size properly, you'll find a strange calmness settles over you. The noise fades, the fear dulls, the need to prove something disappears. You no longer care about being right on every trade. because each one is just a test, a small bet in a larger process. The losses sting less because they cost little, and the wins grow more because they build on one another. It's not exciting, but it's how fortunes are made. Quietly, steadily, safely. So when you open your next trade, ask yourself, if I'm wrong here, can I survive? If the answer is no, you're gambling, not trading. Trade small enough that a mistake doesn't end you. Add, only when the market proves you right. Because you don't get rich from one trade, you get rich from a lifetime of good trades that compound safely. And every one of those trades starts with the same discipline. Control your size before it controls you. Protection and sizing keep you alive. But the third rule decides if you'll ever get rich. I've always said that the hardest battle in speculation isn't against the market, it's against yourself. Every ticker on the tape can lie to your eyes, but it's your own thoughts that lie the loudest. I've seen traders with enough money to buy entire city blocks fall apart because they ran out of something far more precious than cash. They ran out of nerve. And when you lose your nerve, you lose everything. That's why I call emotional capital the real capital. It's the invisible currency that funds every decision you make. If you waste it, no amount of money can save you. When I was younger, I thought exhaustion was just part of the game. I thought the sleepless nights, the pounding heartbeat before a big trade, the constant checking of the tape that was normal. But that's not trading. That's gambling disguised as ambition. The market feeds on emotion. It pulls at you with greed and squeezes you with fear. And if you let either one get a hold of you, you'll bleed out long before your account balance hits zero. There were times I'd make a trade, and even though I was right, I couldn't enjoy it. I was too tense, too wound up, watching every tick like a man staring at a storm through a keyhole. When the market dipped a few points against me, I'd feel it in my chest like a punch. I'd tell myself to stay calm, but I was lying. I wasn't trading my method anymore, I was trading my mood. That's how most traders lose. Not because the market outsmarts them, but because their emotions take over the controls and crash the ship. I remember in those early days when I used to haunt the bucket shops, how the room would buzz when a big swing hit the tape. Men would stop breathing as they watched the quotes jump. You could smell the adrenaline. Some would curse. Some would laugh too loud. Others would freeze. It didn't matter who made money or lost money, everyone was emotionally spent by the end of the day. I learned then that emotional fatigue is as real as financial loss. You can't think clearly when you're drained. You can't plan. You can't act with precision. You start guessing. And guessing is the language of ruin. So I made it my rule to protect my mind the same way I protected my capital. If I felt myself getting tired, I'd stop trading. If I felt angry, I'd walk away. The tape would still be there when I came back, but my judgment wouldn't be if I stayed. The market punishes those who trade from weakness. It rewards those who preserve their strength. I started keeping a mental account alongside my financial one. Every time I let a losing trade shake my confidence, I counted that as a withdrawal. Every time I acted impulsively just to feel in control, I counted that as wasted capital. My goal wasn't just to protect my money, it was to protect my mental equilibrium, because that's the account that determines whether you can keep going. The strongest traders aren't the ones with the biggest bankrolls. They're the ones with the deepest composure. When people ask me how I could isolate myself from the noise of Wall Street, how I could stay alone in a room for weeks watching nothing but the ticker, I tell them, because solitude saves your sanity. The crowd always trades emotions. They call it instinct, but it's just fear in disguise. I didn't listen to tips because tips come from mouths that tremble. I listened to the tape because the tape doesn't tremble, it tells the truth in numbers, and numbers have no emotion. You can lose money 1,000 times and still come back, but lose your confidence once, and you'll never make another right move. Fear paralyzes, hope blinds, and together they drive more traders broke than bad luck ever did. The secret is to stay neutral, to trade from observation, not from emotion. You can't eliminate fear, but you can confine it. You can't kill hope, but you can starve it of control. The market will always test you. It will lure you into trades that look perfect just to see if you can stay disciplined. It will drop 10 points just to see if you'll panic. It's not personal, it's psychological warfare. The trader who lasts learns to keep his composure when everyone else loses theirs. He accepts uncertainty not as danger, but as part of the environment. You can't control the sea, but you can steady the ship. I used to think toughness meant not feeling fear. Now I know it means feeling it fully and still making the right decision. You can't fight your emotions by denying them. You fight them by respecting their power, by building habits that protect you from yourself. I built my rules for that reason, to keep my emotions in check when the market tried to unmake me. So guard your emotional capital the same way you guard your account balance. Rest when you need to. Disconnect from the noise. Let the market move without you. Because a mind that's tired is a trader that's already broke. A general can't command if he loses his nerve, and a trader can't profit if he loses his calm. Protect your capital. Protect your composure, and you'll outlast men who seem stronger but think less clearly. And once your emotions are under control, the third rule teaches you how to make fortune without ever chasing it. It took me half a lifetime to understand that the biggest money is made by waiting. Not waiting for the right moment to enter, that's only the beginning. The real waiting comes after you're right, after you've taken your position, after the market begins to move in your favor and you feel that pulse in your chest that whispers, take the profit before it disappears. That whisper is what ruins most men. They can't stand the thought of giving back what they've gained, so they grab at it too early and cut off their own reward. I used to do the same thing. I'd buy a stock, it would rise a few points, and I'd take my quick profit, thinking I'd done something smart. But all I'd really done was interrupt the natural rhythm of a winning trade. It took me years to learn that it was never my thinking that made the big money, it was my sitting. Sitting tight is the hardest work a trader ever does, because it means holding steady when everything in your nature screams for movement. I remember the crash of 1929 as if it were yesterday. I was on the short side of the market, positioned exactly where I needed to be. The tape was frantic, prices falling through the floor, brokers shouting, the noise like a battlefield, but inside, I was calm. I didn't move. I didn't cover. I didn't try to catch the fluctuations. Every instinct told me to grab some profit, to lock it in, to play it safe. But the market was in full collapse, and safety was in stillness. I knew if I could just endure the storm, the real payoff would come not from trading the crash, but from holding through it. So I sat tight. And while the rest of the street went up in flames, I made more money than in any other period of my life, not because I was smarter, but because I was patient enough to sit still while others burned their accounts down to ashes trying to trade every tick. That's what most people never grasp. The market pays for endurance, not activity. Amateurs equate motion with progress. They think a trader's job is to be constantly engaged, constantly turning over positions, constantly proving he's in control. But that's just insecurity disguised as discipline. The professional knows the opposite is true. When you're right, your job is to get out of the way and let the market pay you. You've already done the thinking. You've already taken the risk. The profit is the market's way of agreeing with you. Let it speak. Let it run. Sitting tight isn't laziness, it's confidence expressed through restraint. It's like a farmer who plants in spring and waits through summer. He doesn't dig up the seeds every few days to see if they're growing. He trusts the process. He waters the field. He watches the weather, but he doesn't interfere, because he knows harvest takes time, and impatience only ruins the crop. The market is no different. When you hold a position that's right, you must give it time to mature. The longer you can hold your nerve, the larger your reward will grow. I've watched men destroy themselves by overtrading. They'd make a good call, see it rise, take a small profit, and then feel compelled to re-enter because they missed the next leg up. They'd buy again at a worse price, get shaken out on a correction, and end up with losses on what should have been a winning trade. They never understood that the money they wanted was already theirs, they just couldn't sit still long enough to collect it. They traded like nervous gamblers at a roulette table, always reaching for one more spin. Sitting tight requires faith not in luck, but in logic. You've done your analysis, the market has confirmed your view, and now you trust that time will do the rest. It's simple, but it's not easy, because patience feels like pain when your mind is restless. The temptation to interfere, to take profits, to hedge, to protect gains is relentless, but each interference is a tax on your future. Every premature exit robs you of the compounding that makes the difference between a good year and a legendary one. In 1907, I saw the same lesson in reverse. I had a position that was right but small, and I couldn't sit still. I took a handful of points when I could have taken hundreds. The market had given me proof, but I was too impatient to let it unfold. That impatience was my teacher. It taught me that once you've aligned with the trend, the hardest and most profitable thing you can do is nothing. So when people ask me what the secret is, I tell them, the market pays for sitting, not thinking. You can spend your days analyzing, plotting, charting, arguing, but in the end, you'll make your fortune by holding on to the trades that are already working. Everything else is noise. Every great operator in history knows this truth. The big moves come to those who wait. Patience in profits is rarer than courage in losses. It's easy to hold a losing position. Hope does that for you, but it takes real discipline to hold a winning one without greed turning it into fear. The market will tempt you 100 times to cash out early. Each time, you must ask yourself, am I selling because the market changed or because I'm afraid it might? If it's fear, then hold, because fear sells too soon and fortune waits longer. The market pays you for time in position, not time on screen. The clock doesn't matter. The chatter doesn't matter. The noise doesn't matter. What matters is conviction, paired with patience. That's the work. That's the craft. That's the art of sitting tight. But sitting tight doesn't mean sitting blind. You must stay awake, alert, and attuned to the pulse of the market. You don't leave the field, you stand guard. You protect your gain not by exiting, but by understanding when the story has changed, because every move, no matter how strong, eventually ends. The trend turns, the rhythm shifts, and the same discipline that kept you in must now tell you when to get out. But that's the next lesson, the one most men never live long enough to learn. Every market, no matter how large or wild, has a rhythm, a heartbeat. Most people never learn to hear it because they're too busy shouting over it. But if you stay quiet, if you watch long enough, you start to notice the patterns. The market always gives clues before it changes direction. It never turns without leaving fingerprints. But those signs don't announce themselves with fireworks, they whisper. And only the trader who's learned to listen can hear them. I used to believe reversals came like lightning, sudden and unpredictable, but that's only how they appear to those who aren't paying attention. In truth, a great move ends the same way it begins, gradually, quietly, almost politely at first. You just have to be patient enough to notice. When I look back at the big turns, I've seen the panic of 1907, the crash of 1929. They all had one thing in common. The market told the truth in advance, but most people were too greedy, too hopeful, or too proud to believe it. That's why I always say, don't sell because a stock is high. Sell because it stopped acting right. There's a world of difference between price and behavior. Price shows you what happened. Behavior shows you what's coming. A stock that's truly strong doesn't just rise, it rises with rhythm. The reactions are normal. The rallies are firm. The volume confirms every step. But near the top, that rhythm starts to break. The pullbacks deepen. The rebounds weaken. The leaders that used to move first now hesitate or lag behind. It's like a prize fighter who's been dominating the ring suddenly taking longer to get off the stool between rounds. He might still look strong, but the energy has shifted. The pace has changed. The end is coming. When I study the tape, I'm not just watching prices. I'm watching behavior. I'm watching how the market reacts to news, to pressure, to time. If good news fails to lift prices the way it used to, that's a warning. If volume dries up on rallies but explodes on declines, that's a warning. If a leading stock stops making new highs while others keep climbing, that's a warning. The signs are always there, but they don't scream. They whisper. In 1907, I was long when the first ripples started. At first, it didn't look like trouble. Prices dipped a little, but they'd done that before. The difference was subtle. The reactions were sharper, and the recoveries were sluggish. It wasn't panic yet, just a loss of confidence too faint for most to notice. I'd seen enough markets to know that when energy fades at the top, it doesn't take long for gravity to take over. I started trimming not because I was afraid of losing money, but because I could see that the character of the market had changed. And sure enough, when the break finally came, it was brutal. Men who'd been boasting of their profits one day were begging for loans the next. They'd ignored the warnings because they were addicted to hope. I'd sold early and watched the floor fall out from under them. That wasn't luck. That was discipline. That was listening. I tell people all the time, the market doesn't owe you clarity. It offers hints. It gives you probabilities, not guarantees. It tips its hand, but it still expects you to have the nerve to act on what you see. Most traders freeze at the first sign of change because they're afraid of being wrong. They need certainty, and certainty doesn't exist in this game. The best you get is confidence born from observation. When you've seen enough patterns play out, you learn to trust your reading. That's not instinct, it's experience disguised as instinct. Think of the market like a river. When the current is strong, you don't have to question it. You can feel the pull, the power, the direction. But as the water begins to slow, as the surface starts to swirl and hesitate, you know a turn is coming. The current doesn't stop in an instant. It weakens, pauses, and then reverses. You can fight it, or you can step aside and let it change. I've learned it's always better to step aside. The river doesn't care about your opinion. Neither does the market. That's what makes trend following so difficult for most people. They're comfortable when things are moving, but they can't handle the in-between, the quiet before the change. They crave confirmation, even when it's already too late. By the time the news breaks, the move is over. The smart money was already gone because it noticed the shift before the headlines. The tape had told them everything they needed to know. I don't try to catch tops or bottoms. That's a fool's game. I sell when the action tells me the move is tired. I buy when the action tells me it's ready. The rest of the time, I wait. When I say the market always tips its hand, I don't mean it hands you the answer. I mean it shows you the odds, if you're patient enough to watch. It's funny, people think trading is about speed. They think it's about reacting fast, jumping in and out before anyone else. But the truth is, it's about seeing slowly. The slower you observe, the clearer the picture becomes. I've spent hours, days, even weeks watching a stock do nothing, waiting for it to reveal its hand. When it finally does, it's unmistakable. And then, when I act, I move without hesitation, because by that point, I've already seen what others haven't. So remember, the market doesn't turn without warning. It turns when enough people have ignored the warnings for long enough. If you can learn to read those quiet signals, the fading volume, the hesitant leaders, the failed rallies, you'll never again be caught off guard. You'll see the cracks forming before the wall falls. The market is always honest to those who listen and cruel to those who don't. And once you know how to read those signs, the final step is the most important of all, protecting your gains without losing your nerve. They say you never go broke taking profits. That line has been repeated so many times it's practically a hymn among traders, and yet it's one of the most dangerous half-truths ever whispered in a dealing room. You can stay solvent by taking small profits, yes, but you'll never get rich that way. Because the great fortunes in this game aren't made by clipping small gains, they're made by sitting through the discomfort of a real move. The hardest trade in the world is no trade at all. It's the decision to do nothing while your profits stretch and twist in front of you, daring you to grab them. Most men can't stand it. They see a little gain, they feel a rush of relief, and they cash out. They think they've outsmarted risk, when in reality they've just interrupted success. I've done it myself more times than I care to admit. I remember one trade in steel. It had broken out after weeks of quiet accumulation, and I was perfectly positioned. I'd watched the tape tell the story step by step, and when it finally surged, I took my profit far too early. The market kept climbing without me. It doubled. I could have retired from that one move, but I didn't have the patience to let it breathe. I thought I was being clever by locking in my gains, but what I really did was rob myself of the kind of profit that defines a career. That's the tax impatience charges, and it never refunds. Letting profits mature requires a strange kind of courage. It's not the courage to take risk, it's the courage to tolerate success. Most traders can handle pain better than pleasure. They'll sit through endless losses hoping for a reversal, but they'll never sit through a rally without feeling an itch to sell. It's because success exposes something deeper than greed. It exposes fear. Fear of losing what you've gained. Fear that the good luck will vanish if you don't lock it in. But trading isn't about luck. It's about rhythm. and rhythm takes time to unfold. The move that changes your life doesn't happen in a day. It stretches across weeks, sometimes months, testing your discipline with every tick. The market rewards those who can detach from short-term satisfaction. It's like watching a fruit tree grow. You plant it, you water it, you wait. The branches fill with fruit, but it's still green, still firm. It's tempting to pluck it early after all. You've done the work, but if you do, it'll never ripen. It'll sit on your table looking perfect until you bite into it and taste nothing but bitterness. That's what taking premature profits feels like. A beautiful nothing. You can't force maturity. You can only wait for it. I've watched traders sabotage their own fortunes because they didn't understand this. They'd ride a perfect move, then jump off halfway through, only to re-enter later out of regret, usually at the top. The market punishes that behavior mercilessly. It teaches you that regret is more expensive than patience. The real discipline is to ride the trend until the market itself tells you it's over, not until your nerves tell you they've had enough. You have to learn to measure the move, not the money. When you focus on the dollar amount, every uptick feels like victory, and every downtick feels like loss. You become emotional, reactive, fragile. But when you focus on the structure of the move, its health, its pace, its character, you can stay detached. The market becomes a wave, and you're just the rider. You don't control it. You simply stay balanced until it breaks. There's a saying I kept in my head: don't take profits, take proof. When the proof changes, when the stock stops acting right, when volume dries up, when the energy fades, that's when you act. Not because the number on your ledger looks good, but because the reason for holding has expired. The market always tells you when to leave. You just have to have the patience to wait for that signal instead of inventing your own. During the bull markets I lived through, I saw a pattern that never changed. The amateurs would take small gains along the way and watch from the sidelines as professionals held their positions and compounded wealth. Then, when the market finally broke, those same amateurs would jump back in out of FOMO, convinced the move wasn't over. They'd buy right into the top and lose everything they'd gained. The professionals, they'd already left quietly, long before the crash. That's the difference between emotion and understanding. When you've learned to let your winners breathe, something inside you shifts. You stop chasing. You stop counting ticks. You start trusting the process. Your trades become fewer, your profits larger, your stress lower. The game becomes less about excitement and more about execution. You start to feel the deep rhythm of the market, the slow, pulsing motion that only patience can reveal. That's when you move from being a gambler to being a true operator. So don't pluck your profits before they ripen. Don't cut short the move that's feeding you. Let it mature until the market itself tells you it's over. Because the market will always try to tempt you into leaving too soon. It will whisper, "Take it," before it disappears. Ignore that voice. The real profit doesn't come from the first impulse. It comes from the silence that follows, from the discipline to stay seated when everyone else is reaching for the exit. Now you understand why gamblers crave action and traders crave confirmation. The gambler trades for excitement. The trader waits for evidence, then waits again for the reward to bloom. That's how patience becomes power. That's how sitting becomes wealth. And that's how every real fortune in Wall Street history has been made, not through noise, not through motion, but through waiting.